discrepancies in a triplet of related cryptocurrency pairs on various exchanges. The execution steps to identify the triplets. Select 3 interrelated cryptocurrency pairs like BTC ETH, ETH USD, and BTC USDT. This is some mind-blowing stuff. Monitor prices. Continuously track the prices these pairs of these pairs of multiple exchanges. Detect deviations in the prices that allow for arbitrage. Execute the trade. Buy BTC and USDT on exchange A. Convert to B on exchange B, and then convert ETH to USDT on exchange C. See, this works better as like on DEXs, because then you don't have to move the coins. You can have it on like I don't know, like Uniswap and SushiSwap, and then whatever the other ones are. Consider transaction costs. Ensures the profits exceed transaction costs and fees. Implement algorithms to automate trading and continuously monitor new opportunities. Concept 2 is triangular correlation arbitrage. Utilize high correlations between 3 assets to create a hedge trade, reducing risk exposure. Select correlated triplet. Identify 3 correlating assets like BTC, ETH, and LTC. Calculate relative value. Monitor price ratios or spread relationships among the 3 assets. Look for deviations from historical norms in these relationships. Enter trades. Buy the undervalued asset and short the overvalued asset based on their correlation relationships. Hedge risk. Use futures or options to minimize exposure. Exit strategy. Close trades when prices revert to historical norms. Strategy 3 is the implied volatility triplet arbitrage. Exploit discrepancies in implied volatility across options on 3 related assets. Execution steps. Track implied volatility. Monitor implied volatility levels for options on 3 correlated cryptocurrencies. Calculate volatility spread. Identify significant discrepancies in implied volatility. Enter trades. Long, low volatility. Buy options on the asset with the lowest implied volatility. Short, high volatility. Sell options on the asset with the highest implied volatility. Neutral hedging. Use a third asset to neutralize directional risk. Adjust positions. Regularly reassess implied volatility levels and adjust positions as needed. Exit strategy. Close trades when vol spreads normalize. Calendar trading strategy. Monthly rollover calendar spread. So trade the price differences between the front month and next month futures contract. Identify calendar spreads. Select the crypto futures contract and identify the first month and the next month. Monitor spread. Track the price spread between these contracts. Enter trades. Long calendar spreads. Buy the next month contract and sell the front month contract if the spread is expected to widen. Short calendar spread. Sell the next month contract and buy the front month contract if the spread is expected to narrow. Consider expiration. Be mindful of contract expiration dates. Adjust positions. Adjust trades based on changes in spread dynamics. Exit strategy. Close positions before expiration or when the spread reaches target levels. Number 2, earnings release calendar spread. Exploit anticipated volatility changes around scheduled events such as earnings releases or network upgrades. Execution steps. Identify key dates. Determine significant events like quarterly earnings, major upgrades for cryptocurrencies. I was gonna put an idea down, but I'm not trading equities right now. Construct calendar spread. Long volatility. Buy short-term options the front month. Okay, I think we did it right. Monitor positions. Track volatility change at. Wait, did we read that? Construct the calendar spread. Long volatility. Buy short-term options front month and sell longer-term options next month or further out to capture volatility spikes. Short volatility. Reverse the trade if expected reduced volatility after the event. Monitor positions. Track volatility changes as the event date approaches. Manage risk. Use delta neutral strategies to hedge directional risk. Exit strategy. Close positions before the event to limit exposure to actual outcomes or exit when volatility targets are achieved. Seasonal trends, calendar spread. Use seasonal patterns in cryptocurrency prices to trade calendar spreads. Analyze historical data, identify seasonality and recurring patterns in cryptocurrency prices. Identify seasonal achievables, for example, end of month price setups or quarterly closings. Set up calendar spreads, high seasonality periods. Enter long calendar spreads on periods historically. Showing price changes.